Across the continent, physical transformations are underway to build the roads, energy grids, and port expansions required to support economic growth. Maintaining this momentum is expensive. Africa currently faces a $400 billion development financing gap every year. Historically, governments relied on foreign development assistance to cover these costs, but as global funding declines, that traditional funding model is no longer sufficient. Without direct capital, critical projects, like the logistics infrastructure required to process millions of cargo containers, risk losing their momentum. This puts pressure on local governments to find alternative funding mechanisms before economic expansion begins to stall. Relying solely on public sector lending and foreign aid cannot bridge a $400 billion shortfall. The existing model has reached its limit. Yet this financing gap exists alongside significant domestic wealth. In fact, African institutional capital is estimated at $4 trillion, and it is already held within the continent's own financial systems. This capital is distributed across domestic pension funds, sovereign wealth portfolios, local savings vehicles, and insurance pools. So, if these trillions are available locally, the question is why they aren't being deployed into infrastructure projects. The barrier is risk. Institutional investors are required to prioritize capital preservation, and many view developing markets as having an unacceptable exposure to political and market volatility. Without a specific mechanism to mitigate these risks, that $4 trillion will remain static rather than entering the real economy. The African Development Bank is addressing this through a targeted $125 million investment. This capital is directed toward a specialized platform known as ATIDI, the African Trade and Investment Development Insurance Organization. ATDI's mandate is to reduce investment risk across African markets by providing insurance products that protect private capital. This investment increases the African Development Bank's shareholding in the platform from roughly 3% to 14%. As a result, the bank is now the largest shareholder in this Nairobi-based guarantee provider. The strategy shifts the bank's role from funding infrastructure directly to strengthening the financial systems that make private investment possible. This approach relies on the mechanics of blended finance. In this structure, ATDI absorbs the initial layer of political risk, deterring private participants. The $125 million investment strengthens ATDI's balance sheet, increasing its capacity. The objective: scale the platform to provide $10 billion in annual investment guarantees. By providing this level of protection, the bank encourages institutional fund managers to deploy their portion of the $4 trillion into domestic projects. This creates a path for long-term private capital to flow into sectors like energy, logistics, and industrial development. The $125 million serves as a catalyst, using a specific amount of public money to mobilize billions in private domestic capital. This specific transaction is a cornerstone of the new African financial architecture, a strategy designed to foster self-reliance. It reflects a shift away from a predominant reliance on external, foreign funding sources. The focus has turned to mobilizing domestic capital pools through market-based risk reduction. Expanding the ATDI platform signals to global markets that African institutions are prioritizing financial independence. The tool for securing future development is no longer a traditional loan. It is the engineering of risk insurance to put domestic wealth to work.